So you're about to get a home loan and you're starting to wonder which type of loan is best for you, a fixed rate, a variable rate, or even a combination of both. But before you can look at what is best for you, it is important to understand what the difference is and of course, what are the pros and cons of each. Hi, I'm Jen. I'm the founder and sole director of 123 Financial Group. We are an accounting, financial planning, and a mortgage broking financial services group working hard to help our clients improve their financial position and guide them to take the next steps in their financial journey. But before we jump in, it's disclaimer time. The information here is of a general nature and it does not take into account your personal circumstances, goals, or needs. Before you make any decision, it is so important that you seek personalised, professional advice. All right, so making a decision about whether a fixed or a variable interest rate is best for you will depend on a number of factors. A fixed interest rate loan will give you certainty with what your interest rate is and therefore what the repayments are, because as the name suggests, the interest rate is fixed and it is fixed for a set period of time. This means that you will know that your repayments will not be affected if the market rate rises or falls. Your repayment amount will be frozen based on the interest rate at the time that you fix the loan and for the period of time that you have agreed to fix the rate for. This period of time could be anywhere between 1 and 10 years depending on the lender, but in most cases the fixed period is between 1 and 5 years. This type of loan is especially helpful for people who are new to the home loan market and are a little bit nervous about their first loan. Homeowners that have a stable but tight budget, or perhaps homeowners whose circumstances are going to change for a period of time. Maybe you have a baby on the way and you know you will be reduced to a lower income for a period of time. The trade-off though for this certainty is that you have very little flexibility when it comes to what you can do with your loan during the period that it's fixed. Most of that flexibility is lost when it comes to making additional payments off your loan to reduce the amount of interest that you pay and access to additional loan features like offset accounts. Although some lenders will allow you to pay small amounts each year off your loan while it is fixed, those additional amounts will not be available to you to redraw should you need the money back until you are out of the fixed period. One of the most important things to remember is that during the fixed rate period, you cannot refinance, restructure, or pay out your loan without incurring a penalty. That is the trade-off for the repayment certainty that you get. But if repayment certainty isn't something that's important to you, then you may be best to consider a variable rate. A variable rate will give you much more flexibility than a fixed rate loan does, but you do lose the certainty that your repayments will not change. Those repayments will change whenever your lender changes their interest rate. But the benefits that a variable interest rate has over a fixed interest rate is that you can pay additional funds off your loan, which will reduce the amount that you are paying in interest to your lender. A variable rate loan will also allow you to refinance or restructure your loan or even pay out your loan without any penalties. Many variable home loans have lots of features that will allow you to take control over your finances and put yourself into a better financial position. A variable rate loan may be the best option for people who know that their income is going to increase and they want to be able to make additional payments when they can to pay their loan off more quickly. Or perhaps people that know they have significant savings that they want to sit in an offset account but want to still have access to those funds at a later date. Of course, with the flexibility that you get by having a variable rate loan, so does the lender. The trade-off for the lender in not having certainty is that they can increase their interest rate if the market rates are rising. Now, if interest rates drop, then you will be jumping for joy because your repayments will also drop with a variable loan. If the interest rate is fixed, you may not be able to take advantage of this reduction in rates. The other side of the coin, though, is if interest rates are rising, so will your repayments under a variable rate loan, whereas on a fixed rate, the lender cannot pass on the rate increases to you. Now, those with the fixed rate will be the ones jumping for joy. Which type of loan that is best for you will be determined by what is most important to you. The certainty of the fixed rate or the flexibility of the variable rate. Still not sure? Well, there's one more option available, a split rate. A split rate is sometimes thought of as the best of both worlds. Part of your loan is fixed rate loan, the remainder is a variable rate loan. You might split your loan with 50% in fixed, 50% in variable, or 20% in fixed, 80% in variable, or any other combination you like. The amount in each is up to you and it will be determined on your individual circumstances. When you structure your loan as a split rate, you will have certainty on part of your loan with repayment amounts and interest rates, and flexibility on the other part of the loan. My advice is to talk to a professional, a mortgage broker, who can work with you to determine the best products, rates, features, and options that suit your own personal circumstances. A mortgage broker is required by law to act in your best interest. If you need more information on anything that I've talked about here, please get in touch or drop a comment in the box below. I've put a pros and cons list on each of these loans together. Click the link below and it will be delivered straight into your inbox. If you need to talk to a mortgage broker, please reach out to me here at 123 Financial Group. And remember to like and subscribe for more tips on how to become financially empowered.